Okay, let's dive in. If you're a business professional, maybe an entrepreneur or part of a corporate team needing those extended stay solutions across Asia, maybe you're in a service department for a few months or even setting up a longer term base. Well, the tax landscape you thought you knew, it's really shifting underfoot. So this deep dive is all about navigating some pretty critical, very recent changes to the tax rules for expats and long-term business travelers right across the Asia Pacific.
That's absolutely right. Our goal today is to, cut through some of the complexity and just give you the essentials. We've looked at sources detailing these brand new policies, things like personal income tax changes, new residency rules, costs across the region, and even some incentives popping up to try and, well, guide where talent goes. The key thing really is precision. The old rules of the road for financial planning in Asia. They're fundamentally changing.
And the place where this change feels most dramatic, perhaps, Thailand. It's been such a go-to destination for expats for longer stays, partly because of its financial flexibility. But now, Thailand is basically redefining what counts as taxable income coming from overseas. So let's get right into that. Thailand's new rules, they kicked in this January 2024. For ages, the system was, well, pretty beneficial for expats, right? If you earned money outside Thailand,
Mhm.
it was only taxed if you brought it into Thailand in the same year you earned it, which, let's be honest, created a pretty useful loophole people relied on.
Exactly. That lag time, that loophole was central to a lot of expat financial strategies.
Yeah.
It let people build wealth internationally while living quite comfortably in Thailand just by, delaying when they transferred their funds. But now that protection is gone. The Thai Revenue Department has made it very clear all accessible overseas income brought into Thailand is taxable now. Doesn't matter when you earned it.
Okay, that immediately flags a question, especially for our listeners who might be using those flexible, extended stay options like service departments. What exactly do we mean by accessible overseas income? Is it just investment dividends, or are we talking salaries paid into, say, a UK bank account, or even capital gains made outside Thailand?
Yes.
Yeah.
It's pretty broad. We're talking the whole range. It covers income from employment abroad, business you conduct overseas, or assets you hold outside Thailand. So foreign salaries, yes. Passive investment income, capital gains, even rent from property you own back home. If you transfer any of those funds into Thailand, the tax authorities are now looking at it.
Mhm.
It doesn't matter if the income was earned 5 years ago or, just last week.
That completely changes the calculation for anyone with foreign accounts living there. Which brings us neatly to the second really big piece here, residency. This is crucial for anyone in corporate housing or using long-term hotels.
It really is the new uh, line in the sand, so to speak.
Mhm.
Your tax liability is now pinned strictly to how long you stay your residency duration. It's got nothing to do with your visa type anymore.
Mhm.
If you're physically present in Thailand for 180 days or more in a single calendar year, boom, you're a tax resident. Now, income earned inside Thailand was always taxable, sure, but that 180-day mark, that's what now triggers liability for your foreign income too.
Okay, for corporate teams managing assignments of varying lengths, maybe using flexible accommodation, how closely are they tracking this 180 days? Like, does the clock reset if you pop out for a week-long business trip to Singapore and come back?
That's the million-dollar question for global mobility teams right now.
Mhm.
No, it doesn't reset easily. The 180 days is cumulative within the calendar year. Total days you're physically there. So short trips out might pause the count for those specific days, but it picks right back up when you return. Your physical presence is key. This puts huge pressure on companies, really, to track where their people are, their accommodation, their travel schedules with real precision, especially with service departments where presence isn't as formally logged as, say, a permanent lease. Get it wrong, exceed 180 days accidentally. You're not just looking at back taxes. Non-compliance could mean serious fines, other penalties.
So that detailed tracking, the record keeping, it's moved from good practice to absolutely essential risk management. But there's a small bit of relief for older funds, isn't there?
Yes, a very specific one. Any savings you'd already built up in foreign accounts before December 31st, 2023. That money is grandfathered in. It remains exempt from these new transfer rules. It's future income and past income earned since January 1st, 2024. That becomes liable when you bring it into Thailand.
Right. Okay, so this tightening in Thailand, it feels like part of a bigger pattern, maybe? Governments everywhere seem to be looking more closely at expat finances. So let's zoom out a bit. How does Thailand's move change the game strategically for businesses deciding where to place their people in Asia?
It definitely forces a rethink. Lifestyle and cost of living are still factors, of course, but the total cost of employment, including tax, becomes much more central. Our sources consistently point to Japan and China as, well, the most expensive places in Asia Pacific right now to employ a mid-level expatriate.
Really? Why is that? Is it just higher local salaries?
It's more complex than just salary. It's often driven by things around the salary. We're talking significant Social Security costs, often high mandated housing allowances, plus the costs of navigating pretty robust regulations. When you add up that whole annual package cost, those two countries really stand out for having, let's say, higher friction for placing expats.
Okay. What about the big hubs like Singapore? Everyone uses Singapore as a regional base.
Singapore is an interesting case. Yes, it's still an expensive place. Overall cost of living, housing, definitely high. However, its famously low personal income tax rates, especially compared to other major Asian centers, help to kind of moderate the total employment cost for the company
Yeah.
and the burden on the employee, obviously. It's a classic trade-off. High operating costs, but offset somewhat by tax efficiency.
Makes sense. And as some places tighten up, like Thailand, maybe others start looking more attractive. Are there alternative spots gaining ground for companies looking for, tax efficiency for these longer placements?
Yes, definitely. Malaysia and Vietnam come up frequently. They're seen as kind of the rising stars for talent placement right now. It's that combination of growing economies and, generally speaking, still quite favorable tax rules for foreign professionals.
And digging a bit deeper, beyond just income tax, our sources mention specific places that are attractive for wealth management, for higher net worth individuals or entrepreneurs. Can we list those?
Sure, these are places offering particular advantages, often beyond just salary tax. The list usually includes Singapore again, Malaysia, South Korea, Taiwan, Hong Kong, but also the UAE and the Philippines. A key benefit many of them share, and something professionals are definitely looking for, is having no capital gains tax on overseas investments. If you're generating significant returns outside your main job, that's a huge financial draw.
It's really valuable context for anyone weighing up long-term residency options. Now, let's swing back to Thailand quickly. We've talked about the net tightening for existing expats,
Right.
but interestingly, they're also running this quite clever program to attract their own skilled people back home, trying to reverse the brain drain. It highlights this kind of strategic tightrope Thailand's walking, maybe restricting some foreign capital flows while actively trying to pull in high-value Thai talent.
It is smart, yeah. A very targeted incentive program aimed squarely at the global Thai diaspora. And it's not just a short-term thing. This plan runs until the end of 2029. They're quite specific about who qualifies.
Okay, so what are the criteria? Who are they trying to lure back?
Two main things. First, you need at least a bachelor's degree. Second, you need proof of at least 2 years of solid international work experience. Thailand clearly recognizes that the skills and experience gained in competitive global markets, well, that's exactly what they want to bring back into their own economy.
And what's the incentive? What's the tax carrot being offered to get these qualified Thais to come home?
The big one is a flat, fixed 17% income tax rate when they return. That's designed to make moving home financially appealing, perhaps making it comparable to tax rates they might have found in other, say, lower tax countries abroad.
And they're making it easier for companies in Thailand to hire them too, sort of subsidizing bringing this talent back.
That's right. Employers in specific targeted sectors think high-value areas like tech, R&D, advanced manufacturing, they get a pretty significant break too. A 50% tax exemption on the salary cost for hiring these returning Thais. So it works both ways. Lowers the barrier for the employee to return and for the employer to hire them. It helps ensure these valuable jobs actually get created back in Thailand. And yeah, running until December 31st, 2029 signals it's a pretty serious long-term commitment.
Okay, let's try and tie this all together then. What does all this shifting mean for you, our listener, the business traveler, the corporate planner, using those extended stay options in Asia?
I think the number one takeaway is that the days of sort of casual residency planning are well and truly over. The tax landscape across Asia is dynamic, it's changing, and it demands constant attention and really meticulous planning. If you or your teams are using flexible stays, that 180 threshold in Thailand and similar rules elsewhere, that's not just a detail, it's mission critical. It directly hits the financial viability of assignments. Understanding when income was earned versus when it's transferred, keeping absolutely detailed financial records. These aren't just nice-to-haves anymore. They're essential for managing risk.
Couldn't agree more. And given how complex it's getting and the potential costs of getting it wrong, seeking professional jurisdiction-specific advice seems like the only sensible path. And maybe a final thought to leave you with. Given that this hard 180-day line now determines tax residency in Thailand, it does raise an interesting question, doesn't it? For long-term travelers, for corporate teams managing mobility, Are we going to see companies start deliberately timing these extended stays, structuring them to come in just under 180 days purely to manage tax liability? Could this fundamentally change the whole rhythm of business travel? Long assignments getting split into maybe two shorter stints, forcing companies using service departments and the like to manage a whole new layer of logistical complexity. Something to perhaps mull over until our next deep dive.